Let's talk about something that quietly affects almost every part of your financial life: interest rates. They influence your mortgage, your credit cards, your car loan, and even the money sitting in your savings account. But what exactly are interest rates? Why do they change? And how do they impact your day-to-day money decisions? In this video, we'll break it all down in simple terms. Let's start with the basics. An interest rate is the cost of borrowing money, or the reward you earn for saving it. When you take out a loan or carry a balance on a credit card, the bank charges you interest. When you deposit money into a savings account, the bank pays you interest. These rates are usually shown as percentages. The higher the rate, the more you pay to borrow, or the more you earn by saving. So who sets these rates? In most countries, a central bank, like the Federal Reserve in the United States, sets a base interest rate. Banks and lenders use this rate to decide how much interest they'll charge or pay. When inflation is high or the economy is running hot, central banks often raise rates to slow things down. When the economy is weak or unemployment is rising, they lower rates to encourage spending and borrowing. Now let's see how this affects you. When interest rates go up, loans become more expensive. Mortgage rates rise, meaning your monthly payments are higher. Credit card interest increases, so carrying a balance costs you more. Car loans and personal loans also get pricier. On the flip side, savings accounts and certificates of deposit often pay more interest. When interest rates go down, loans become cheaper. You might get a better deal on a home or car loan. Credit card rates may drop slightly, but savings accounts usually offer very little interest, so your money grows more slowly. Here's a quick example. Let's say you're buying a $300,000 home with a 30-year fixed mortgage. At a 3% interest rate, your monthly payment might be just above $1,200. If that rate jumps to 6%, your payment rises to about $1,800. That's over $500 more each month, just because of interest. That's why small rate changes can have a big impact. Now let's talk about savings. When interest rates are high, it's a good time to look at high-yield savings accounts or fixed-term deposits. You can earn more on your emergency fund or short-term savings. But when rates are low, your money won't grow much in a regular savings account. In that case, people often look at investing for better long-term returns. But that comes with risk. So what should you do when rates change? If rates are rising, it might make sense to pay down variable rate debt quickly. You could also lock in a fixed-rate mortgage before things get more expensive. If rates are falling, consider refinancing existing loans to lower your payments. And be cautious about leaving too much cash in low-interest accounts for too long. Always keep your financial goals in mind and adjust your strategy as needed. Interest rates may seem technical, but they affect your wallet more than you think. Understanding how they work gives you more control over your money and your choices. If this video helped, subscribe to Smart Cash Lab. We post daily videos that make money feel simple, smart, and clear.